All right, my dear friends. I am Rennet Premnath. If you're able to hear me, begin to chat, begin to say where you're joining me from. I see around 6 people already joining the session, Recession, when money fails. This is going to be an important topic that I want to share with people so that we all be ready for times ahead, all right? God gives wisdom to operate in the times when things are not going okay, all right? I'm not saying recession is coming. I'm not saying thou shalt fear. That's not what I'm saying. But just get ready, dive in, and I'm going to present certain things that I am seeing, and I'm going to share some wisdom based on things that I've learned and some research from across. So this will be a very important thing for you, myself, all of us to tune in and listen. All right. This is going to be an amazing session today. So I'm going to play one of the experts right now. The moment I play, you'll know who this person is. Just a short clip. You may not fully understand what he is saying. That's okay. All right, that's okay. But I'm just going to play this clip. Is that okay?
You've got to crank in interest rates because everything in valuation gets back to interest rates. And if you take the U.S. Treasury bill now, which is, we'll call it 80 basis points, depends what maturity, that means the U.S. Treasury bill was selling at 125 times earnings. Now, if your alternative is to buy something at 125 times earnings, or a good business whose earnings will probably increase at 15 or 18 times earnings, you've got to measure it against the risk. It isn't really a risk-free instrument, but the standard rate. And in 1982, the rates got up.
All right. So coming back to you, that is a well-known veteran in finance, a very successful value-based investor, Warren Buffett. I don't know if you fully got what he said, but what I'm going to talk to you today is going to be somewhat related to what he just shared. You may have fully understood, you may not have fully understood, but that's totally fine. But if you're watching me, and I see some 9 people watching me from across, so just put in your name wherever you're joining me from. Like I said, I'm Rennet. My background, I'm a pastor, but I also have something else. I have over 10 decades of experience in financial services industry, very strong basis in data analytics, from educational and experiential qualifications, strong in financial engineering, financial markets, investments. But this is not an investment advice session, okay? I'm not giving you investment advice. I'm just doing some education here. This is financial education, nothing more than that. I just want people to be aware of what the times that we are living in, all right? So that you will know what to do at the right time. And I just want to speak wisdom and clarity during the times that we live, because many people don't see what is happening, and when you don't know what is happening, you will never be prepared for what is coming. And I'm going to repeat that. If you don't know what is going to be happening, you will never be prepared to what is coming. So my heart and the spirit behind why I'm doing this educational session is for you to know what could be coming ahead. All right. And so you can be prepared for the times that are coming. And so your decisions that you are making today, the decisions that you're going to make in a week, the decision you're going to make on a Monday can hinge if you know other things that are going to happen in the future, so that you will be better prepared of how to be operating in the days that are coming. Is that okay? So before going ahead, I'm going to read a verse from the Bible. And this is taken from Genesis chapter 47, And this is where I got the title, When Money Fails from. Okay, Genesis chapter 47. I'm reading from verse 14 and verse 15. And Joseph gathered up all the money that was found in the land of Egypt and in the land of Canaan for corn which they bought. What? Joseph, he gathered up all the money. Joseph gathered up all the money that was found in Egypt and in Canaan for the corn which they bought. And Joseph brought the money into Pharaoh's house. Listen to this carefully. Joseph was not doing charity work during a time of famine. The Bible clearly says that Joseph took all the money from Egypt and from Canaan, and he brought it to the house of Pharaoh. And watch, 15th verse. And when money failed in the land of Egypt, what happened? Money failed in the land. And in the land of Canaan, money failed in the land of Egypt, money failed in the land of Canaan. All Egyptians came unto Joseph and said, give us bread. Why should we die in your presence? For the money faileth. Okay, so the terminology that is used here for money in Hebrew, it corresponds to silver. During those days, they did not have currency like we have today. When I use the terminology money, most of people's mind will go to a US dollar or a yuan or a rupee or a dinar or whatever, right? So we are not talking about currencies here, okay? We are talking about silver or gold, tangible money, real money. There is a big difference between what you and I hold today in our hands, which is a currency. A currency is very different from real money. Real money is silver and gold. But what we hold in our hands today is just a currency. And I'm not going to go into the depths of that right now. I will be doing more sessions on this topic in the days to come. But I'm just going to keep it at a very high level. But right now, I just want you to understand from the scripture that when money failed, people came to Joseph and they said, Joseph, Mr. Great Joseph, money is failing. We want to continue living. Give us bread. And guess what Joseph did? And Joseph said, Joseph did not do charity work, but Joseph said, give your cattle and I will give you for your cattle if money fail. So what he's saying is, hey, although your money failed, there is something more you have, which is probably during a time like that, a time of famine, was much stronger or had a value than money, okay? Which was cattle. And he said, bring me your cattle and I will give for your cattle. Now, I'm going to stop there because this is more of a financial session. This is not a Bible study. I'm not going to give you revelations today, but there is going to be wisdom from the Bible that's going to be coming towards the end, all right? But I just want you to think about what's happening right now, and I'm going to bring up certain topics here for you to understand, and I'll slowly walk you through, okay? I'm not going to get too sophisticated in what I'm explaining, but I want you to see what truly is happening in our economy at this point in time, all right? Number one, my question begins with saying, are we getting into a recession? Well, why am I asking that question? Because I'm seeing a few things. Number one, interest rates are rising. I'm pretty sure anyone who has been following whatever news or whatever is happening around, you all know interest rates are rising. Number two, bank failures are rising. And I'm going to go into details of each of these, all right? Number three, productivity is declining. Number 4, VIX, which is a volatility index. It is a market index, usually called as fear index. Okay, as of I think 4 or 5 days ago, VIX rose to 13.3 million open interest, meaning there are a lot of option traders betting that there is going to be a pretty bad collapse in the market. Okay, I'm not saying that's going to happen. Okay, all that I'm saying is, for me, when I look at what's happening in the economy right now, number 1, interest rates are rising. Number 2, bank failures are rising. Number 3, productivity is declining. We are seeing VIX rising. And what I'm going to walk you through, it is more of a holistic research that I quickly did. I'm getting some insights from Morningstar, from S&P, Market Intelligence, Visual Capitalist, Market Watch, Macro Trends, McKinsey Global Institute. So you see the number of places I've researched, right? Now, I'm not promoting any of these companies. I'm not saying go follow them. I'm not trying to sell you a financial product. I'm not asking you to give me money. None of that is involved. This is more of trying to get the people of God educated during a time which could become a recessionary period, based on what I'm seeing. So that is the intention of this whole conversation. And, one thing I would encourage you to do is, if you have questions, I want you to type your questions in the chat window, all right? If you happen to have any questions, type your questions in the chat window. I will, towards the end, I will try to answer some of those questions if you have any. But I thought, the people of God should be prepared. Watch this. Jesus said, you got to be innocent as doves and shrewd as serpents. You need to know what's happening around. Joseph knew what was coming. Hence, he prepared himself, his family, Pharaoh, to go through this famine. But let me tell you this. This is very important, and people at times, they do not understand how the Spirit of God works. Okay, Jesus loves the poor. Okay, but Jesus is not doing charity during famine. Okay, if you pray, he will help you. But more than that, you need to seek wisdom. A lot of people perish during famine. All right. Thank God that there were people of God who knew Joseph, who was operating in wisdom. Amen. And so God rescued their lives because a man was able to interpret a dream that what was coming ahead, and he could prepare his people. He could prepare a whole nation and the house of Pharaoh from completely collapsing. However, it collapsed the whole economy of Egypt. It saved a few people. So, God wants you to operate in wisdom. I pray that the spirit of wisdom will come upon you. Okay, I'm a minister, so whenever I say the spirit of wisdom, people only see it from a standpoint of getting revelation. God can give you revelation about the things that are to come. All right, God can give you $1 billion idea. God can give you. He is God. God is not inside a church. Okay, the earth is the Lord's and everything in it. I want you to understand that. Okay, so now I'm going back to the research. I'm going to go one by one. Again, the few things that I'm looking at a high level. Interest rates are rising. I'll explain why I think that could, what that could mean. And I'm going to say bank failures are rising. I'm going to say what that could mean. Productivity is declining. I'll say what that could mean. And fear index is going up. Okay, first, are we in recession? Before diving into this, I want to explain or define what recession is, okay? A recession is a significant, widespread, and a prolonged downturn in economic activity. a common rule of thumb is that 2 consecutive quarters of negative GDP. So basically, and this is a definition from Investopedia, and it could mean so many different things, but one of a proxy, a approximate way of knowing if we are if there is a recession is to see GDP. If the GDP for 2 consecutive quarters is down, then we know we are in recession. Now, this is a lagging measure. When I say lagging measure, there are 2 types of metrics. Now, I'm wearing my data and analytics hat, okay? There are 2 types of measure. One is called lagging, the other one is called leading. A leading measure can foretell what could happen, okay? A lagging measure will tell you about something after it happens, okay? It is lagging in a sense. After the event, you will understand, oh, this happened. Many times, people who only use lagging measures, they are reacting. They are not proactively moving in wisdom. They have succumbed themselves to the issues and the situation around, and they are already under a tough situation, and then they are looking behind and saying, oh my gosh, look at GDP now, it's gone down. So GDP coming down is a lagging measure, because you're not going to get GDP numbers on a high frequency. You need to wait to see, okay, next quarter, did GDP go down? The next quarter, did GDP go down? If GDP went down, you are already in recession. So you never prepared for the recession. You are just going through everything, and then you saw and identified, oh my gosh, we are in a recession. And no wonder my finances are not good. No wonder things are not working, right? That is a more reactive method. So this way of identifying is a lagging measure. Meaning you go through a problem, you go back, think about this, right? Let's say you have had a problem in your feet or whatever. You go to a doctor, they do a deep diagnosis, and then you identify a problem, and they say, oh, you have this big issue. Now that is reactive, that is lagging. But what if somebody told you, hey, if you did this and that, these are some symptoms, if it is arising, that is leading you in the wrong path. So you better shift and prepare so that you are better off in the future, and that you're not succumbing yourself to whatever could happen in your life. Is that making sense? I'm just explaining what a lagging measure is, okay? So recession is a widespread, prolonged downturn in economic activity, usually measured by consecutive quarters of negative GDP. All right, this is a lagging measure, and I'm saying that very importantly because everything I'm going to show you right now is all leading measures. Leading measures have the ability to, in somewhat, forecast or foretell what could come. Think about prophetic. People say strategic. I say prophetic. People say forecast. When you can see what is coming, you are actually seeing into the future. All right? And you are preparing. That is what happened in the time of Joseph. Through a dream, God explained what was to come. He was using a leading measure that was coming from God to him. And he said, I need to prepare my people. I need to prepare my nation. I need to prepare during this time. This is how we are going to overcome the situation. So God gives wisdom the moment he reveals what is to come in the future. Now, I'm not saying this is a prophecy, okay? If God tells me something, I will tell you that. But at this point in time, what I'm giving you are some measures that I'm seeing that may not be looking good, all right? So now, and again, if you have any questions, please put your questions in the chat window. Now I'm going to the next one here. Interest rates. Interest rates are rising. Why is that a problem? Watch this. This is 2008. We all know about 2008 subprime mortgage crisis, right? During 2008, we had a major issue with subprime mortgages. But if you see what happened before that collapse, interest rates went up higher and higher and higher and higher and higher and higher. Okay? See, the blue line is a federal interest rate. Okay? The way interest rates were increasing. Okay? You see that? The blue line? Starting at 24, when they started increasing. This was not 24. This is like 25, 26, okay? When they started increasing, what happens, I'm going to explain why Fed increases interest rate. Now, listen to me here. When the supply of money or the velocity of money is high, what does the velocity of money mean? There is too much currency in the market. How did we have too much currency in the market? You saw what happened during COVID, and our president Biden and their company, they started printing dollars. And I'm going to show you how much got printed during that time. So when so much dollars and free money is given, what that does is it increases velocity of money. And what velocity of money increase will do is increases inflation. You all looked at the asset prices going up. You also how the prices of eggs, prices of gas is going up. It was all an effect of velocity of money, the speed of money circulating in the market went up pretty strongly. Not because of increase in productivity, because credit was put into the market. So when people started printing money, it increased the velocity of money, which started increasing inflation. Now, when inflation begins to increase, the way that we are right now, the Federal Reserve, which is a central bank, all right, the Federal Reserve's main job is to ensure that inflation is good. They are just trying to oversee the economic conditions of a nation, because inflation going up and going up and going up is not good for the economy. It pretty much eats up all the value of your dollar. Okay, you could have bought maybe a dozen of eggs for $2, but now you need $6 or $7 to get a dozen of eggs. What that means is your dollar lost value. You are still buying the same egg, the same amount, but you got to pay more, meaning the value of your dollar eroded. In order to bring that valuation under control, what the central bank do is they increase interest rates. Okay, you may ask, why do they increase interest rates? When interest rates are increased, think about this in a very simple way as opening a tap and closing a tap, okay? When you open a tap, a lot of water comes down. That is what they did when money was printed and they had the interest rates really low, okay? When the interest rates are low, people will go get many loans. People will go borrow. Because why? The cost of money is cheap. Okay, so people will begin to borrow more and more and more, and they go shopping spree, they buy businesses, they do different things with the borrowed money. Now, that is an open tap condition, meaning interest rates are low. That is where we were. But now, the Fed is closing the tap. Okay? When you close the tap, what happens is they are reducing the supply of money. Is that making sense? They are reducing the supply of money. When the supply of money goes down, what happens is demand for money increases. So the cost of money is very expensive. For example, during those conditions, your interest rates go up. If you want to get a loan, you cannot get a mortgage for 2.5% anymore. You got to pay 7.5%. Why? The demand for money is more now. Interest rates have increased. They are trying to control the supply of money. So what happens now is people are going to borrow less. Okay? People are not going to spend enough. Corporations are going to say, I know that I planned for so much, but I'm not going to spend so much because I'm not anticipating enough revenue. For example, your target will say, hey, because interest rates are high, people are not going to borrow and come and buy enough, so we are going to reduce our revenue forecast. So when that happens, everybody is going to say, oh my gosh, money is going to be tight, so I'm not going to spend. So people are not going to borrow. Okay, so I'm going to go back to this. Watch. When interest rates go up, are you all following what I'm saying? Am I going too fast? All right, so here I have a question from Quenisha. What was the purpose in printing so much? COVID relief, advances? That's a good question, Quenisha. So, there are different types of philosophy in which people try to help economy, okay? Usually, our president's philosophy, as our president sits in the office in democratic rule, their philosophy is a lot different than how a Republican philosophy would operate during these times, okay? First of all, it is COVID relief, which was necessary. Everybody was in agreement. Both Republicans and Democrats were in agreement. And again, guys, I'm going to say certain things. I'm not going to side any political party or this or that. Number two, I'm a person who respects anyone who's in the office, okay? Once a person gets into an office, could be the right way, could be the wrong way, because they've gotten into the office, I am going to call them president, okay? Not because of who they are, not because of how they got there. They just got into an office, and I'm respecting the office, not necessarily my ideas of that person, okay? So, but anyway, coming back to this. First of all, they were printing to help during COVID relief. But after that, they started doing way more than what was really necessary for COVID relief, okay? So in many ways, my thought is that level of printing was not necessarily necessary, okay? There were some advances. For example, there was this moratorium on rentals, right? People were not required to pay rentals. Even a lot of organizations, they stopped billing their people. In many ways, several types of advances came to people as benefits to overcome this whole COVID situation. But the amount of money that was later printed past COVID relief to send more checks to people, free money to people, that I don't believe was needed. And more money was printed not just for American citizens, it was printed to send to other places internationally too. So, this is just not about how much of money circulating only in the United States. This is about the amount of USD that is circulating across the world, okay? So when the USD across the world circulation increases so much, it's gonna hit the value of the dollar. All right, and it is going to internally in our country, it caused inflation. Okay, I hope I to somewhat answered your question, Quenisha, but that is a reason why they were printing a lot of money. But anyway, like I said, watch this. When interest rates are low, the supply of money is high. Okay, just simple math. Interest rates are low, supply is high because people can buy cheap loans, get cheap loans. They can buy different products, right? So they are spending. If you really think about what GDP is a measure of the amount of spending that's happening. Because the thought is if the productivity is high in an economy, people will spend and buy services. Meaning I produce something, you have to buy. So whenever a transaction happens like that, more transactions and high dollar transactions create high spending, creates high GDP. Okay? So when interest rates are low, GDP is going to be high because people are going to be spending more generally with their products and services. Okay? Now, slowly the opposite begins to happen when interest rates go up, because now money is expensive, because you cannot get the loan or a mortgage at the same price you got a year ago or 1.5 years ago. Now you got to pay 7.5% or whatever to get your mortgage and other loans. You know, people who have outstanding loans, especially when it's variable, they have to pay more on a monthly basis. You know, they may have been paying less because their variable rate was really low. But when interest rates go up, now they have to pay way more than what they used to pay. So now this will eventually cause a liquidity crisis. Okay? When interest rates go up, it'll get to pinch the monthly spend for people because they owe more because interest rates have gone up. I hope you understood that. Now, this is just not about interest rate going up. This is about interest rate, how quickly it is going up. All right? If you think about this, in our 2008 crisis, interest rate went up over time. Okay? And what happened during that time, many people had, bought homes beyond their means, okay? Balloon and different type of financial methods were used to get a property. Now their repayments went so high, skyrocketed, and they couldn't, and they walked out of the property. And that hit a domino effect in the entire market. Banks started collapsing. Lehman Brothers, Bear Stearns, Washington Mutual, all these big banks collapsed because when interest rates go up, usually loans become delinquent. When delinquencies go up, it means you're not getting paid. You know, the person who lent money is not getting paid because people are not able to afford to pay them back. All right. So delinquencies go up, defaults go up. This will cause a liquidity crisis in banking market. Okay. So that's what happened in 2008. But if you see the interest rate, how it went up from, let's say, 2005, and it was going up, sustained in that level, and then boom, collapse happens at that point. Now, if you watch what's happening here in 22, the interest rates are going up real quick. This to me is like a step move. It is, you're talking about 22 was already a loss year in the stock market, okay? And I'll talk about that. But generally, in starting early, late 21, interest rates have been going up, and now the latest is it's up by up to 5%, right? It moved from approximately 2% to 5%, which is a pretty big increase, and it's going back close to pre 2008 collapse levels, okay? And it is moving really fast. And I'm showing you guys this. Number one, please don't panic. Okay? I'm not a person who's trying to create panic here. I'm just giving you a view into what is happening in the market. Okay? So when these things go up like this, what happens is usually banks experience liquidity problems. Why banks experience liquidity problems? Several reasons. Number one, delinquency could go up. Defaults could go up. Recently, SVP collapse, bank runs are happening because other companies are collapsing who did not have enough liquidity to run, right? So all of these happen. So is that, are you all following with me? Are you all following with me? All right. Good. Just give me a thumbs up or say yes, you're following. I just don't want to go too deep. And if you have any questions, let me know. This is the blue line, correct? Yes, it is the blue line. So the blue line is what we're talking about. The blue line is the federal interest rate that's going up, okay? Okay, so now I'm going to the next slide here. that I have, which is bank failures. Remember, I told you when interest rates go up, defaults happen, delinquencies happen, bank runs, that'll cause liquidity in the banks. Now, what is surprising is this is not the number of failures yet, because we are still in the beginning stages, okay? The interest rate just got up. It is sending some shock into the economic system of United States, all right? It just shot up. And what happens across the world is if Fed increases interest rates, other central banks around the world, they begin to increase interest rates. LIBOR, in UK, central bank in England, Europe, everybody will start raising interest rates, okay? We are talking about a global interest rate rise, because usually what happens with the Fed, it begins to impact a global central banks, all right? Okay, now watch this. Now we are still in the beginning stages, right? Because I told you the interest rate went up really quick. They've been moving up, boom, 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 boom. And now, as of right now, at least in the United States, 2 big banks failed. It is not a high number as 2008, but if you look at the total assets, that is where the problem is. The total assets with these 2 big banks, you may ask, what are the 2 big banks? I'm talking about Silicon Valley Bank and Signature Bank, okay? Silicon Valley Bank is a bank, both are in California. These used to fund a lot of startups, okay? A pretty strong exposure into startup tech type banks, So Silicon Valley Bank and Signature Bank, a lot of businesses hold their bank accounts here. This is heavily these are not big consumer banks like JP Morgan Chase or Bank of America, but these are major business banking banks. So when these banks fail, what happens is a lot of businesses are being impacted. Forget about just consumers, but now business gets impacted. But thankfully, what the United States government has said is, the people who had money in these banks, don't worry, we will bail you out. Now, what that means is, United States, you need to understand this about the United States. We do not have a savings account. I'm talking about United States of America. United States of America is in $31 trillion debt. When somebody says, we are going to bail you out, it is taxpayers' money and it is printing more money. Okay? There is no other way to bail people out, because we are already living on credit in the United States. It's a major credit-based economy. So when the government says, I'm going to bail you out, they are either hitting, they are hitting taxpayers and or printing more money. And this is a lot of money. And again, this is going back to, this is like $150 billion failure that's happened. And this is just happening in the United States. People, there is another major collapse that happened in Switzerland with Credit Suisse. That is another big billion, like I think 200 billion or whatever, major big bank. And that has been bought over by UBS, United Bank of Switzerland. Now, that is another collapse. Okay, there are other collapses that are now recent news is Deutsche Bank. Deutsche Bank is in turmoils. So what I'm saying is this is just not what happened. We are just in the beginning. So that's why my question is, are we entering into a recession? I'm not saying we are in the recession. Unemployment rates are low, great. I'm not saying we are in the recession. All that I'm saying is, hey, interest rates have gone up so much. We are already having bank failures that we saw, and there are a bunch of, I think nearly 70 more banks that are not in a good state in the United States. But we're also seeing international banks, in Swiss, major big bank, Credit Suisse, failing now, Deutsche Bank coming under turmoil. So this is beginning to take a form in the banking market, okay? So I just want you guys to know what I am seeing. And again, I'm going to give you how you should be thinking, what your state of mind should be. This is not a fear thing that I'm imposing on you, but I just want you to see what could happen if these things continue in the future. So I'm going to see if anybody has any other questions for me. All right. How are banks different than credit unions as it pertains to this? Okay, that is a good question. See, banks are different from credit unions in this way. In banks, banks are privately owned usually, okay? There are a few people or shareholders who own banks. But when it comes to credit unions, it is member-owned. Members, people who put money into the credit union, they are the ones who own credit union. So credit unions are non-profits. Banks are not. Think about banks, I don't know if I can phrase it this way, but banks are more thought of like sharks in the market because they are there for profit. They'll sell you whatever product you want, whenever you want, this and that. But, I'm not against them. Banks are good. I have banking relationships. But credit unions are more softer in nature because they are non-profit. They're trying to help a community. They are more from a membership, members own credit unions. It's a non-profit. It is banks are private, and the regulations are very different. Banks have a different type of regulation, financial regulation and rigor in comparison to credit unions. And banks are prone to have more risky assets in their portfolio or in the balance sheet than credit unions. I'm just giving some generic statements here, okay? Yes, Summit is a credit union. So they are not necessarily a bank. But interest rates impact everybody. So interest rate impacts both banks and credit unions. So if you just think about a consumer behavior, there could be possibilities of defaults, but the type of defaults and delinquencies that could happen in a banking sector is very different in many ways than what could happen in a credit union sector. These are just my thoughts. Okay? So they are different. Credit unions are different from banks. Now, I'm going back to my next slide here. So, I'm just going to ground a little bit here, okay? I'm going to take you guys to this first slide. I said interest rates are going up. So I said when interest rates go up, money gets tighter, cost of money gets expensive. There is potential for spending to go, it is directly proportional. Spending is going to go down because people are not going to spend the way they used to spend in the past, okay? So what that means is GDP can get impacted, all right? Now, when interest rates go up, banks are, if you think about, in a very simple way, what is the business model of a bank? They just take deposits from you and me, okay? They put it in their, if you think about the balance sheet of a bank, you as a depositor into the bank, you go put money into the bank, okay? According to bank's balance sheet, that is a liability for them, okay? It is not an asset for the bank. It is an asset for you, but for a bank, it is a liability. What do they do with the liability? And at times, they pay you some small interest, right? So they immediately take your deposit and loan it out to somebody else. So bank's basic model is they take money from people and turn around and loan it out to somebody else. If you think all your money is sitting in your bank account, I'm sorry, it is not. It's Probably somebody is having it in the form of a loan, but they are obligated to pay you back, okay? Because that is your money, which is why banks have FDIC, meaning it is insured. Up to 250K deposits are insured. Why? Banks could fail. Because banks have a business model of taking your money and loaning to somebody else. If they lent out that money to a person who is less credit worthy, they could lose all that money and depositors could lose their money. Is that making sense, people? So, it is important for you to know that, all right? Okay, so now I am going back to this here. Watch. Interest rates are going up. So GDP could go down. Banks are in the business of taking your money and loaning it out to somebody else. So interest rates directly impact banks' business model, big time. Okay? All lenders, their business model is impacted. Okay? So that is why you're immediately seeing an impact in the banking sector. All right? So now I'm going to go back here a little bit and talk about, I showed you this picture. Think about this. In 2008, major bank failure was Washington Mutual. It was bought out by JP Morgan Chase. You're talking about $188 billion in asset. Okay? Watch this. $188 billion bank was sold to JP Morgan for $1.9 billion. Oh my gosh. Just imagine this. Just imagine the amount of profit of this guy made out of that bank. I know some of these assets could be in a crisis, but just imagine the profit JP Morgan Chase made in that acquisition and all the depositors he had. He got more money now, right? But I'm just saying that was a major failure. But we are right now seeing failures to that order, okay? Failures to that order right now, just with Silicon Valley Bank and Signature Bank. All right. So now I'm moving into the stock market. All right. Now I talked to you about interest rates. I talked to you about how that could impact GDP. I talked to you about bank failures. And now I'm talking to you about the market. And I'll tell you why this is important. Okay. 2008 was, all of us know, it was one of the worst years in the market. All right. A negative 33.84%. Major decline in the market. Now, after 2008, the worst year after 2008 was 2022. We've been doing 18, 11, 5, 7, 26, 7, negative 2, 13, 25, negative 5, 22, 7, 18. Now, the next big loss year in comparison to 2008 was 22. Okay? It was not a good year in the market. Now, there are many value-based investors like Warren Buffett and Charlie Munger and others say the next decade is going to be a loss decade. For the next 10 years, we are not going to see profits like we've seen, according to their analysis. Okay? So that is, I'm not saying they're always right, but Warren Buffett is known for very good value-based investments, and they have shown their ability to predict cycles really well. Okay? But generally speaking, 2022 was not a very good year. And this year, it looked as though the market was soaring up in the beginning. As of this point in time, we've given up all that we've gained for the year. So you're back to zero, maybe even lower right now. But usually, why am I showing you this is stock market is more like a leading indicator for the economy. Okay? If you think about COVID, even before economy became really bad, stock market started going down. So we may, consumers, people living in an economy may have experienced impact in May, June, July, whatever. But stock market started collapsing starting Feb, March. Boom. Market was already down because it was already predicting what could happen in the economy. So stock market is usually a predictor of what could happen in the economy. And in some ways, it predicted what could happen with the year 22, okay? I'm not saying they are always predicting, but generally speaking, they are good predictors of what could happen in the market, okay? But now, so I just brought this picture to you to let you know that, hey, since 2008 collapse, we had a worse year in 22, okay? Now, I see Quenisha asking a question. Do banks fail because borrowers aren't paying back? That is true. Mostly that is why banks fail. Or the depositors. What happened in SVP is now depositors are going and saying, I need my money now, I need my money now, when the bank was not even expecting that so many depositors will come and get money from the bank. It's like this. Let's say you had $1 billion in your bank and your whole bank's asset was only $2 billion. If you go ask them all that money today, that bank will most likely fail because they do not have $1 billion sitting somewhere. They have loaned that money to somebody else, and that person cannot pay so quickly. Is that making sense? Especially when interest rates go up. Now, I'm giving you a worst case scenario here, okay? When interest rates go up, there is a possibility that your lender, although they said you have 30 years, although they said you have 5 years to repay, they may come to you and say, you gotta pay it now or you lose your property. You gotta pay it now or you lose whatever you got, okay? These things could happen. They don't usually happen. They could happen, all right? In a normal situation, banks fail because borrowers didn't pay back. But when fear strikes the market, people begin to act adversely in an unpredictable manner. So during those times, depositors are just getting money out. Now the bank doesn't have that money to give. So they begin to say, oh my gosh, I'm bankrupt. I cannot pay my depositors. So those are the things that begin to happen, okay? So now here, I'm going to the next slide. Now I'm talking about productivity, okay? Now this is my last I'm going to talk about another 10 minutes, okay? If you all have more questions, put your questions there, and I'm trying to answer as I go. U.S. labor productivity is running well below its long-term averages. Now, this is not a short-term indicator. Productivity is usually a long-term indicator. Okay, in my next video, I'm going to talk about basics of economy. All right, how does this economy run, right? So I'll talk a little bit of basics about this, but productivity is usually a long-term predictor, okay? But for a long time, I'm talking about 70 years. For the last 70 years, we have been in a decline of productivity, okay? This is more like when a long-term trend and a short-term trend combine and hit at the same point, the ramifications could be bigger, okay? I'm not saying that's what's happening right now. I'm just showing you a chart, right? Since 1948, all right? Since 1948 until now, the general trend of productivity is down. Why is that important? The basis of economy is you produce something. Only if you produce something can people buy. If there is no transaction, economy doesn't exist. Okay, let's say somebody's got to, sell a ham. Somebody's got to grow a cattle. Somebody has got to do something. So you value it, you pay money. When the transaction happens, that is how economy runs. Okay, so but when productivity over time goes down, that is not a very good sign. We need increase in productivity. See, the prediction of McKinsey is if we change the direction here and go back to the productivity levels of what we used to be here, they are saying like we could make like $3 trillion back just by increasing productivity. We can produce so much more. You're talking about $3 trillion in more money or more transaction just by productivity increase, not by pumping dollars. I don't want to go into the depths of it. This is not a great sign. So this is another indicator for me that, hey, we are not necessarily going in the right direction in our economy. Okay. Now this is from McKinsey Global Institute. All right. So I'm now going back to the first base slide. Okay. I talked about interest rates rising, which could cause GDP issues because spending is going to go down. Bank failures are happening. Productivity is declining. And the next one is VIX index. VIX is a volatility index. Usually it's called a fear index. It's again in the options market. CB, Chicago Board of Exchange, is where it's traded. So it usually indicates, hey, are we expecting some bad times in the market? VIX being up just means, hey, there is no big certainty. People are not too confident about what's going to happen. So it tracks that. And over time, if it goes too high, people are really uncertain. They don't even know what's going to happen. But I'm not going to show that trend right now. I wouldn't say it is at a very high levels at this point in time, but it's inching up. I just took all these different measures to tell you, when I look at all these different measures, it is not a comforting measure. Okay, and I'm talking to you more from a macro levels, right? I'm not saying, hey, everything is going to collapse tomorrow. Take your money out of your bank. That's not what I'm saying. Okay, but as you look into the future, things are not looking too great. So what do you do at such times? Okay. There are a couple of other things. I'm not going to cover that. I'll keep it for the next time I come. First one, you are people, I'm talking to people who are followers of Christ, or if you are not a follower of Christ, the first point applies to you, even if you're not a follower of Christ. Okay? The first point is do not fear, because the moment you fear, you are going to make wrong decisions. I don't care who you are. If you are operating in a panic mode, you will make wrong decisions, okay? Not just for you. You will create an effect of wrong decisions, because one wrong decision impacts, your decision, as long as it's contained to yourself, usually it does not, because your decision impacts your environment. Your decision impacts somebody else. Do not operate in fear. Do not panic. That is not the way to go, okay? So whoever you are, you're Christian, you're not, you're a follower of Jesus, you're not, do not fear. Do not panic. Just know, because, you got to know these things. I'm not a person who's operating in fear right now, okay? Number two, if you know Jesus Christ, and if you do not know, you can receive him in your heart today, okay? You can just say, Lord Jesus, I know that you died on the cross for me. Lord Jesus, I know that you have died to set me free. You died for my sin. I believe that you are Lord of my life. Come into my heart and change my life. If you do that prayer with all your heart, Jesus will come into your heart, okay, today. So now why that is important? Why is that important? Well, people who are in Christ, You are not part of this economy, meaning you are not only part of the earthly economy, you are part of kingdom economy. You are part of the economy of Jesus Christ. Okay? Though you are in the world, you are not of the world. You and I, we have the wisdom, we have the power to operate above, over and above, okay? We have the power to operate over and above what is happening in the market. I want you to understand this. You and I have the power to operate over and above the market conditions because your trust is in the Lord and my trust is in the Lord. So what does that mean? See, be faithful to the things of God. Be faithful in the things of God. Whenever you are trusting God's economy, make a decision. Lord, no matter what happens, I'm going to do what I have decided to do for your kingdom. If you are tithing, tithe. If you are sowing, sow. You know, your seed during a time of famine will have a greater harvest than during a time of plenty. Now that is that's a kingdom principle. I'm not going to go into that. I told you this is not about raising money or anything like that. I'm just giving you how do you become part of a kingdom economy. You do not become a part of kingdom economy just because you say Jesus, Jesus. Okay? You follow the principles of the kingdom. If you do not follow the principles of the kingdom, you cannot partake in kingdom's economy. Is that making sense? So, be faithful with what the Lord has given to you, and the Lord will bless you. The Lord's favor will be upon you. Because during downturns like this, people, this is just not about your wisdom, because the whole economy is going through problems. You need favor. I need favor. We need God to work on our behalf, because money can fail, but Jesus will never fail. Money will collapse. Jesus, his kingdom is a kingdom that will never end. Okay? So the moment you attach yourself to Jesus Christ and you operate in the principles of the kingdom, you become part of a kingdom economy. But what the enemy will do with all his heart is try to plug you out. Because the moment you're plugged out of a kingdom economy, you are susceptible to this world economy, big time. Okay? Your thought is, how do I continue operating in a kingdom economy? The moment your principles do not align to the principles of the kingdom, you are basically saying, I am coming out of kingdom's economy to operate in the world's economy. So that's what's basically happening in the realms of the spirit. Okay. The third point, be wise with your spending and investments. What do I mean by this? Don't go borrow a big loan amount now and, say, hey, I'm going to take a vacation, or I'm going to make this trip, I'm going to make that trip, I'm going to do a home improvement. No, this is not the time to be getting big loans, okay? Because number one, the cost of money is high. The cost of your dollar is high. I may sound a little bit more passionate here. This is just, it really does not make sense for you to go be borrowing money now. If there is opportunity for you to consolidate your debt or reduce your debt in some way, that is a better place to be. Okay? So be thoughtful. Don't be going out there and taking major loans and spending big money, going on vacation, this and that, on loan. If you have money, go do your vacation. But don't be spending borrowed money for wrong decisions. Is that making sense? Because the cost of money is high right now. And investments. Again, this is not an investment advice. I'm just giving you education here. And I'm going to say personally, I'm not representing any company. I'm not representing anyone. I'm just personally telling you, do not be, too much exposed to markets these days. You know, people are already seeing major swings. I think the day when the Fed recently raised the interest rate, Dow was down by 600 points. That's a lot of points to be down by, okay? The next day, it went up by 200 points. So it is a very volatile situation, people. Unless and until you are a professional trader who know to trade volatility, okay, you keep doing what you're doing because you know what you're doing. If you are not a professional trader who knows how to trade volatile situations, don't get do unnecessary things in the market. It's not a good time. I'm talking about both stock market or bond market. I will, in my next video, I'll say certain things where, I think could be some avenues, where you can park your funds. But again, I'm not giving you investment advice. I'm just giving you education around how I think. But I want you to do your own research and make your own decision. Is that making sense? So right before I conclude today, again, if you have any questions, post your questions. Interest rates are going up. Bank failures is rising. Productivity is declining. VIX is going up. And my research is from Morningstar, from SP Intelligence and Visual Capitalist, MarketWatch, Macro Trends, McKinsey Global Institute. None of these people are paying me anything. These are just places where I research on my own, okay? I'm just letting you know, this is not just Rennet saying something. I just did some research and put my spin on this whole story because these are certain indicators that are important to see, okay? So finally, that is the end for today. Do not fear. Trust in the Lord. Be wise in what you're doing. I will see you again in the next installment of more to come in financials and what you do during recession. How do you operate in wisdom during these times? So I'll talk more about that in the upcoming days. All right. So thank you for joining me today. If you like the show, give it a like, subscribe to my channel. If you think others might find this beneficial, forward it to them, share it with them. Thank you. We'll see you again pretty shortly and pretty soon. All right.